Good day everyone, this is Maria Alexandra Mansov from AAS 3A. So for this day, I'm going to discuss some of the topics of the Chapter 8 in Operating and Financial Leverage. The rest of the topics will be discussed by my groupmates. So before we start the discussion, I would like to show you the topic objectives. So we're going to discuss what is leverage, CVP analysis, sales mix, and operating leverage. So let's start. What is leverage? So leverage represents the use of fixed cost items to magnify the firm's results. It is, however, important to keep in mind that leverage is a two-edged sword, producing highly favorable results when things go well and quite the opposite under negative conditions. So leverage in the business. So what is leverage in business? So assume that there exists an opportunity to start your own business. You are to manufacture and market industrial parts such as ball bearings, wheels, and casters. You are faced with two primary decisions. So first, you must determine the amount of fixed cost plant and equipment you wish to use in the production process. So by installing modern sophisticated equipment, you can virtually eliminate labor in the production of inventory. At high volume, you will do quite well as most of your costs are fixed payments for plant and equipment. So if you decide to use expensive labor rather than machinery, you will lessen your opportunity for profit, but at the same time, you will lower your exposure to risk. Second one is, you must determine how will you finance the business. If you rely on that financing and the business is successful, you will generate substantial profits as an owner paying only the fixed cost of debt. So of course, if the business starts off poorly, the contractual obligations related on that could mean bankruptcy. So as an alternative, you might decide to sell equity rather than borrow as debt that will lower your own profit potential but minimize your risk exposure. So in both decisions, you are making very explicit decisions about the use of leverage, to the extent that you go with a heavy commitment to fixed costs in the operation of the firm. You are employing operating leverage. So to the extent you will utilize that in the financing of the firm, you are engaging in financial leverage. We shall carefully examine the type of each leverage and then show the combined effect of both. So we're going to proceed now in CVP analysis. So what is CVP analysis? CVP analysis, or cost volume profit analysis, is a powerful tool that helps managers understand the relationships among cost of the products that they sell, which means the production itself, the production number of units and how many units are being sold, and also the profit associated with the manufacturing process. So CVP analysis focuses on how profits are affected by the following 5 factors. So we have 5 factors to consider, which is the selling price of the product and the number of units that is being produced and sold, which we refer to as the volume of sale, and then we also have the variable cost per unit, so the total fixed cost and the product mix. So one of the main points in the discussion of CVP analysis is the determination of the entity's break-even point. So this model is used to answer a variety of critical questions such as: what is the company's break-even volume? What is its margin of safety? What is likely to happen if specific changes are made in prices, cost, and volume? So financial managers need to know the costs that are likely to be incurred under normal operating conditions and how they might vary if conditions change. They need to understand which cost would stay the same and which cost would follow the movement of volume and so on. So one of the main points in the discussion of CVP analysis is the determination of the entity's break-even point. So what is break-even point? The break-even point is the point wherein the entity does not enjoy a profit but does not incur a loss. So what does it mean? So hindi sila kumikita but at the same time hindi rin naman sila lugi. So that happens when total contribution margin equal to the fixed cost in the production process. So this is determinant in how much sales or how much units to be sold to be able to at least cover all operational costs. So kumbaga, the break-even point gives you the guidance that this is the number of units that you should be able to sell or the amount of sales that you should achieve in order for you to not to get lost, but at least you can cover all the operational costs of the company. So we do have assumptions and limitations of CVP analysis. So CVP analysis constitutes a very important tool for management planning. Certain underlying assumptions upon which it rests, however, place definite limitations on the conclusions which can be drawn from its results. So whenever the underlying assumptions of CVP analysis do not correspond to a given situation, the limitations of analysis must be clearly recognized if the break-even tool is to be useful and educational. So in summary, the following static assumptions will limit the precision and reliability of given break analysis. So first assumption, we have the analysis is valid for a limited range of values or the relevant and the limited period of time. So failure to observe limits would lead to working with unrealistic data. Second one is all costs can be categorized as fixed or variable. So semi-variable cost represents problem that can be solved by segregating fixed and variable portions. So we do have here variable cost change proportionately with volumes within the relevant volume range, and the fixed costs are constant within the relevant volume. So there is danger that linear cost and revenue relationship may be used when non-linearities are significant, and nonlinear curves often have optimum quantities, or linear ones do not. So the third one is revenues change proportionately with volumes, with selling price remaining constant. So price is constant if volumes within the relevant range. So fourth one is there is a constant product mix. So therefore data should be adjusted for any shifts in product mix. The fifth one is changes in volume alone are responsible for changes in costs or revenues. So there are other factors affecting costs and revenues, but they are lessened if narrow time and volume limits are applied. So sixth one is there is no significant change in inventories. For example, in physical units, sales volume equals production volume. So data should be adjusted if inventories change markedly. Operation leverage questions can be dealt with in the CVP framework. So this should be supported with capital budgeting approaches that consider the time volume of money. And the last one is analysis is deterministic and the proportionate and appropriate data can be found. So by the means of that, uncertainty and probabilities approach can be introduced. So now let us proceed to contribution margin per unit. So contribution margin per unit or marginal income per unit is the excess of unit selling price over the unit variable costs, and the amount each unit sold contributes toward covering fixed costs and providing operation. So let us now proceed to CVP analysis for revenue and cost planning. CVP analysis can be used to determine the level of sales needed to achieve a desired level of profit. In revenue planning, CVP analysis assists managers in determining the revenue required to achieve a desired profit level. So the equation that may be used to compute for a target sales follows. So to get the sales in units, you need to determine the total fixed cost plus desired profit divided by the contribution margin per unit. Or, in sales in peso naman, you need to determine the total fixed cost plus desired profit divided by the contribution margin ratio. Let us now proceed to sales mix. So what is sales mix? Sales mix refers to the relative proportions in which company products are sold. The idea is to achieve the combination or mix that they will yield the greatest amount of profits. Most companies have many products, and often these products are not equally profitable. Hence, profits will depend to some extent on the company's sales mix. In addition, profits will be greater if high margin rather than low margin items make up a relatively large proportion of total sales. Furthermore, changes in the sales mix can cause perplexing variations in a company's profits. A shift in the sales mix from high-margin items to low-margin items can cause total profits to decrease even though total sales may increase. Conversely, a shift in the sales mix from low-margin items to high-margin items can cause the reversed effect. First one is total profits may increase even though the total sales decrease. It is one thing to achieve a particular sales volume. It is quite another to sell the most profitable mix of products. So let us now proceed to CVP analysis for a multi-products firm problem. So this is the example. Lore Incorporated produces only two products, A and B. These account for 60% and 40% of the total sales pesos of stores respectively. Variable costs as a percentage of sales pesos are 60% for A and 85% for B. Total fixed costs are 150,000 pesos. There are no other costs, so here's the requirement. First, we need to compute the weighted contribution margin ratio. Second one is compute the break-even point in sales pesos. Third one is compute the sales pesos necessary to generate an income of 9,000 pesos if total fixed cost is increased by 30%. So here's the first solution to the first requirement. Sales mix ratio for the product A is 60% and for the product B is 40%. To get the contribution margin ratio, which is the 40% and the 15%, we need to deduct the percentage of sales peso, which is 60% for product A and 85% for product B. So how to get that? Note that the sales is equals to 100%. So to get that, we need to subtract the 60% and the 85% to get the 40% and the 15%. So 100% minus 60% is equals to 40% for product A, and 100% minus 15% is equals to 85% for product B. So how to get the weighted contribution margin ratio? So to get that, we need to multiply the sales mix ratio times contribution margin ratio, which is 60% times 40% is equals to 24% for product A, and 40% times 15% is equals to 6% for product B. So the total answer here is 30%. So the next one is the break-even point units. So how to get that? So the break-even point in sales in peso rather. So how to get that? So our formula here is break-even point is equals to total fixed cost divided by the CM ratio. So our total fixed cost is 150,000, which is given, and 30% of weighted CM ratio, which is given then, which is nakuha natin dun sa una nating sinove. So 150,000 divided by 30% is equals to 500%. So let us proceed to the last requirements. So the formula here is sales in peso is equals to total fixed cost plus desired profit divided by contribution margin ratio. So desired net income is given, the 9,000. Then we're going to add the fixed cost, 150,000, to get the 195,000. We need to multiply the 150,000 times 130% is equals to 195. Then to get the contribution margin, we need to add the desired net income plus the total fixed cost. Then we're going to divide the contribution margin ratio, which is the 30%. So to get the sales necessary to generate desired net income, we need to divide the 204,000 pesos divided by 30%, which is the contribution margin divided by the weighted CFR, is equals to 680,000 pesos. So